Okay, so what we've done, we've kind of moved through the 1040. We've done the front page, page 1, we've done income. We got this number, our adjusted gross income at the bottom there. We took it to page 2. We looked at itemized or standard deductions to lower that. Then we had our exemptions, and we calculated our tax bill. And then we learned about the refundable and non-refundable. Non-refundable, so Pac-Man's trying to eat up our tax bill. And then refundable, eat whatever's left. And then if there's any left over, that's what we get back. Okay? What we're going to do now is adjustments to income. Okay? Bottom of page 1 of the 1040. This is what's going to determine what we go to page 2 with when we start to calculate our tax. So obviously this is a section where we really look at what we can do to lower that income before we get into our itemized. And I kind of feel like this section, the adjustments to income, this is kind of one of those elective sections, okay? Nothing's really based on calculations. A lot of it is just based on what you elect to do, okay? We're going to start out, and if you look at page 10.3, we kind of go right down all the lines there on the adjustments to income, okay? We're going to pretty much hit everything with the exception of military performing artists and fee-based government officials, okay? Specialty one, you don't see it. Just know there for knowledge that it is in there, okay? But we're going to go through all the other ones. We'll talk about them. Some of them we'll touch on because of where they are as far as adjustments to income. But a lot of the detail will come into more play when we do some other things, especially like the self-employment tax. Okay? Educator expenses, you know, that's one that we see quite a bit with teachers. They know they get that $250. We talked about on our job related that if it's in excess of that, we're going to put it on there because, you know, some teachers spend more. I have somebody in the night class that's a teacher in the schools in Buffalo. He pretty much doesn't want to have to go through the red tape of submitting a proposal to the school board. So he goes and buys his own specimens for when dissecting, just gets them online because it's a lot quicker and a lot cheaper. Okay. Said the only hard one to do is he's got to go through the school board when he's ordering chemicals because they kind of frown on him buying chemicals on the internet in this day and age. Because if he gets the wrong one coming in, they got Homeland Security at the door. So, all right. But, you know, those are things he does over and above. So he has things in excess of his $250 that we'll see there. Health savings account. We've talked about them a little bit when we talked about healthcare. We're going to talk about how they work as far as when you can deduct them. Some people will have them on their W-2 because their employer contributes, or it's on their W-2 because it comes out and lowers their taxable income on their W-2. So this one, where we see this adjustment, is going to be much more where we'll see where somebody contributes out of their pocket with taxed dollars, okay? Moving expenses, all right? Just because you move down the street or cross town doesn't mean that you get to deduct. We'll see the little test there of 50 miles, all right? And to think about it, if you live on the east side of Buffalo and you move to the west side of Rochester, depending on where you were for your old commute and stuff, there's a good chance you might not be able to write off your moving expenses because you might be within 50 miles. Okay, but we'll see how that works. The deductible part of self-employment tax, we've seen this in action a little bit. Basically what this is when somebody's self-employed, they pay Social Security and Medicare on their tax return. Okay, we've seen that with our little brief introduction to Schedule CEZ. We'll talk about this more when we get to the Schedule C in the chapters later. But your employer gets a credit for paying your Social Security and Medicare. So the government has decided if you're self-employed and you're paying your Social Security and Medicare on your tax return, equally you should be able to get a credit too. So half of that tax you get as an adjustment to your income, okay? Self-employed simple and qualified plans. We'll talk about these and I'll show you how these work. For a self-employed person, these are great because you're not limited like you would for a traditional IRA to $5,500 or $6,500. Some of these you could be contributing $25,000. Okay, and I'll explain how they're a great thing for a self-employed person to get cheap health insurance. Okay, self-employed health insurance deduction. Now, you have to be careful with this one, because if you're self-employed and you're paying your entire family's health insurance out of there, do we get to take everybody or just the self-employed person? Yeah, okay. Because really we can only deduct as an expense there for the self-employed, the person that's generating the income. Okay. The other ones, the wives and the kids, where would they go?
Medical expenses.
Are itemized, exactly. Yep, medical expenses are itemized. All right. Penalty on early withdrawal of savings. We saw that when we did our 1099 interest back in our interest and dividends. You know, there's that little column there for interest. We saw on that. You see those? See that a lot right now because people panicking with their CDs and other things, pulling money out, putting it somewhere else, and just biting the bullet on the penalty. Used to not see it at all because everybody wanted to leave their money in there as long as they could to get the interest. But when you got interest rates hovering around 1% or less, sometimes people panic. Okay. Alimony paid. All right. This is one that if somebody's claiming it as income, somebody gets to claim it as an expense. But remember our definition, it has to be alimony. This is not maintenance of the home. This is not child support. This is alimony. Okay. I taught a class last night. There was somebody that is a divorcee, and I could tell they just had a settlement with their lawyer, and she was picking my brain on which is which. And I pulled her aside afterwards, and I said, yes, I think that you're going to be paying tax on all that money. And yes, your husband is going to be deducting it as an expense. So she was not really happy, so I imagine her lawyer's getting a call this morning. And then I'll probably get a call this afternoon from the lawyer and say, why'd you throw me under the bus? IRA deduction, we'll talk about how this works. This is the one that you see most people do. This is the one you see Esther talk about on the radio, where she does, you know, between the end of the tax year and tax deadline. If you have a tax bill, think about putting money into an IRA, and we'll show you how that works. Tuition and fees. This is kind of adding to what we learned in 16 about the American Opportunity and the lifetime learning credits. All right, we'll kind of show you in the problem. There is a perfect storm, especially when you have a graduate student. 9 times out of 10, if you have an undergrad, you want to go to the American Opportunity. Because why? The refundable portion, okay? Because you know you're going to get something from it no matter what. But sometimes somebody that's in grad school, this lifetime learning, you want to make the comparison. We'll see that in the problem, okay? All right. Now, what I found with this chapter, when you're reading through it, it gets a little bit clouded, okay? Because they're throwing a bunch of stuff in there that kind of, you know, kind of throws you off a little bit, okay? So what I found is the best way to do this is we're just going to go right down page 1 of the 1040, okay? So if you have a return on your computer that you want to open up and you don't mind messing with, just find one in there and go to page 1 of your 1040, and we're going to go right down to the bottom, okay? So I'm going to kind of do it as a hybrid. I'm going to show you the forms inside and the places that we put it inside the tax return, and then I'm going to talk about each one and determine it on, okay? Educator expense is our first one, okay? So we go in there, our little square, get our little connection. We got a little worksheet, everybody's favorite thing to find, okay? And the second item down there, you see educator expenses. Amount of unreimbursed classroom expenses such as books, supplies, computer equipment, and related software, other equipment, supplementary materials, all right? It says $250. However, what's the next sentence say? Amounts over $250 should be listed on Schedule A job expenses subject to 2%. What if I have somebody that only spends $175? Do I still give them the $250? Nope. Okay. So if somebody comes in, yeah, I spent $250 in supplies in the classroom. Well, obviously they know the threshold. Do you have receipts for this? Yes, I do. Okay. So You know, that's pretty much our, you know, due diligence. But, you know, if somebody has over that, you know, you put it on there and then you have to explain to them that it's subject to that 2%. And it can be each. So if you have 2 teachers, taxpayer and spouse, they each get the $250. All right, so it's per person. It's not total. Okay. And again, has to be classroom expenses. All right. Okay. All right. So back to 1040, page 1 to the bottom. Our next one is what we're going to skip. Health savings account. Okay. So go in there, click, and you're going to open your 8889. We actually have a form for this. Okay. Now, oops, too big. Okay. All right. So I actually have a form for this. Now, it's going to be in one of the 2's names, taxpayer or spouse. Okay. It will be for the self or the family, depending on how the insurance is set up. What this determines is the maximum contributions. Okay. You saw a little table in your reading that talked about the maximum, so you have to do that. Now, this one, HSA contributions made for 15 or those made on your behalf, including those made January 1st, 16 through April 18th, 16, that were for 215. Do not include employer contributions, contributions through a cafeteria plan or rollovers. So basically what's that saying? Anything that's on our W-2 that has lowered our taxable income. Because if we put it there and it's on our W-2, what have we done? Double dipped. Okay? So we don't put it there. All right? You can see it kind of defaults because it knows it's a joint return. It defaulted to the 6650 for the max contribution, the limitation. Okay? So we have that as a max. All right? But again, do not put it in there if somebody says, oh yeah, it's on my W-2, I contributed. Well, again, cafeteria would be box 14. Box 12 would be a W code and then the amount. So box 12 has a W, stands for healthcare. That means they contributed there. Then it would carry over to this, okay? This line right here is something that I would take and say I have $100 a month deducted out of my checking account to my HSA. That's my contribution. It's not for my payroll, it's my contribution, okay? So you can see the limitations there, all right? Okay. If you are 55 and older, you do get to do a little catch up. I don't know whether I've told the story in here, but I have my mother doing that right now because the thing about an HSA is that she can put that in there, it rolls over. When she's fully retired, no longer working and on Medicare, that account becomes a hybrid. She can still use it for her medical expenses, tax-free in, tax-free out, but it also becomes an IRA, okay? So she can take money out of there like it's a traditional IRA and pay tax on it as income, all right? No penalty for taking money out of the HSA. Because if we take money out of an HSA, and I'll talk about it here in a second, there's a penalty if it's not for medical purposes, okay? So then you can see that it calculates your HSA deduction. Now, part 2 is distributions. Basically, all we're doing on this tax form is reconciling that the money that went out for qualified medical, okay? What I mean by that is you get that little debit card and you got to spend it on your co-pays or vision or dental or whatever you use it for. You basically put in the distributions and then you come down to 15 and put the same number in if it was all for qualified. And that's what you ask the client. That's it. It's done. It's not taxable, nothing. Okay? However, what's the tax if we take something out for non-qualified? 20%. Okay? But if any of the distributions included in line 16 meet any of the exceptions to the additional 20 checks, check here. Well, that's where we were talking about. That exception would be my mother when she's a full retirement age and on Medicare. that's no longer working, that money becomes an IRA. Now, granted, it's in a spot where it's not earning like an IRA would be for a traditional IRA. You know, HSAs earn basically right around the interest rate. But what we've allowed her to do is kind of create a hybrid fund so she has this money. She's got like $18,000 or $19,000 in it. So hopefully for anything she has for medical expenses through the remainder of her life, it will cover all the copays. If she needs to dip into there, it only comes out as taxable income. It's not subject to the 20%. Okay? So it's something to think about for people, you know, that have a lot of medical needs and a lot of copays even when they retire and go on Medicare. Because it's a way to kind of have money set aside that, and then if they don't use it, what do HSAs have? Anybody ever fill out a form for an HSA? It's got a beneficiary. So it's not like the money's lost. That way it becomes just like an IRA, and there's a beneficiary that gets the remainder of the funds in there as the recipient.
So you don't have to use it each year?
It rolls over, exactly. Yep.
Okay.
So we max her out. We're doing catch up. She does use some of it for things. You can't use it to pay premiums. You know, it has to be co-pays and, you know, vision, dental, you know, anything like that. So there is restrictions on it. But, you know, it does work well because she's going to have this fund set aside. Now, this is where everybody always asks, too, about what Mr. Trump's going to do with health care. From my understanding from reading, from what he's planning to do with the health care law, is he is going to allow the 26-year-old threshold. You can stay on to your 26th birthday on your parents. He's going to allow the no pre-existing to stay and the lifetime limit. Okay? Which to me, of the Affordable Care Act, those are the three most important components that was in there. The rest of it was a waste of time. Okay? Because it didn't work the way it should. All right. No pre-existing. That way, you know, right now I'm helping a bunch of clients because CCS Oncology has dumped independent health. They will no longer take independent health insurance as of January 1st, 2017. They got in a fight and they didn't get along in the sandbox, whatever you want to call it. Okay. So now people that are in treatment that I help with health insurance are trying to scramble around and find. And obviously, if you're seeing CCS Oncology, you probably have a lot of other doctors you're seeing. We have to find out what those doctors take that CCS takes and get them new insurance because they were on independent health. So that's a shame that things like that have to happen. Okay. And the lifetime one, best example I use, one of my friends that was in my wedding had a daughter that was born with cancer. By the time she was 2 years old, she reached her lifetime limit. She lived to be 14, and between 2 and 14, they had to pay all the medical expenses. They did not get insurance for her. And it was millions of dollars. Okay, all right. So they had her for 14 years. I mean, she's passed a long time ago, but they, you know, they're still paying off her medical bills. So that's another thing that's nice about the lifetime. Okay. What I see him doing is I see an expansion of the health savings account and dropping the penalty, the mandate. So for those people that don't want to pay for health insurance, their option would be to have an expanded health savings account. Based on their income, it sounds like the government may match what they contribute. So depending on their income. So they would have this account, and if they don't have health insurance, that's what they would have tax-free to pay for their medical. They have a medical event. Okay?
But then would they be able to pay for premiums or no?
Not with that, no. No. So it's kind of a way for, and it's going to add. So it's good. It gets rid of the mandate. You know, the penalty for not having health insurance. To me, that was a silly part of it. It's just not working the way it is. And I think, too, the other thing that will happen is we'll get rid of a lot of these steep thresholds for the premiums. Right now, $23,760, $20 a month. You make less than that. You make $24,760, an extra $1,000 of income. You're probably going to spend probably about $110 a month and have about a $3,000 deductible for least expensive insurance. If you want to pay for the same insurance that you get if you made $1,000 less than 20, that would be a platinum, so you're probably going to pay about $350. So basically what I'm saying is if somebody makes an extra $1,000 over that threshold, they went from paying $240 for the coverage that they have to about $3,600. So to me, that math makes no sense, and that's the thing I think he's going to change. It makes no sense that if you work harder and make $1,000 extra, that basically that $1,000 cost you $2,000 worth of income because of your medical expense. That makes no sense. Why would anybody work hard enough to get it? You know, it's great for retirees, that threshold, but for somebody that's working and growing and stuff like that, okay? The other thing is, anybody got a calculator? Anybody got one on the phone or anything? Anybody? Tell me when you're ready. All right. I have a family of two. All right. And right now they're baggage handlers at Chicago. O'Hare. The ones that are on strike. What are they striking for? To get what?
$15 an hour.
Okay. Take this family of two. Take 15. Multiply that by 40. And multiply that by 52. Okay. What number we got there, Tim?
31,200.
Okay. 31,200, right? 31,760 is the threshold for a family of two to get $20 a month insurance. You think that's a coincidence? All right. So I don't believe in coincidences, but I'm beginning to wonder. Okay. All right. So you can see how that works. Now the health savings accounts, again, for somebody it's ideal because what's going to happen? They're going to get extra money to pay for their health insurance. And as we see, as it stays here on the adjustments to income, we can lower our tax bill too. Now, the thing about that, and I tell everybody, health savings accounts, you put $1,000 in there, lowers your income. It might only cost you $850. You might save $150 on your taxes. So you just took your medical dollars and you stretched them. Okay, elective thing on there, right? So that's the health savings account deduction. Again, when you do it here, the big thing is that it's an adjustment by your contributions out of your pocket, not anything that's on your W-2. All right? All right, back to 1040, page 1. We are now down to moving expenses. We have a little form, it says on there, 3903. So we're going to open our 3903, okay? And at the top, we have a distance test. This is what I was talking about. First thing we figure out, number of miles from your old home to your new workplace. So I'm at home, obviously I'm going to move, and my new workplace, okay? So we figure out those miles. Number of miles from your old home to your old workplace, okay? You subtract that from line 1, is it at least 50 miles? That's why I say, sometimes when you do this math for somebody that moves from Buffalo to Rochester, it's pretty close, depending where they live. You know, if you're living out in Akron and you're moving to Rochester for a new job, chances are, you know, unless you're going to work on the opposite side of Rochester from Akron, you know, you might not meet 50 miles, okay? So that's where you can do that, all right? Talks in there when you're reading, it talked about the 39-week, you know, as far as how long you're there, okay? It's one of those things, you know, if I move temporarily, I'm temporarily relocated, that's kind of what that's for, all right? This is much more for a permanent move, all right? Now, our expenses that we can take for moving. Transportation and storage of household goods and personal effects, okay? So if I rent a U-Haul and I move more than 50 miles, I can write that off. And if when I get there, my new home is either construction, it's not finished, or, you know, I can't close until Monday after there, and I got there Saturday, or a couple weeks, or whatever, and I have to put my goods in a storage place, those are what things I can do there. Okay. Next one, traveling and lodging expenses moving from your old to your new home. Okay. As you can see there, the IRS again has determined that we have to eat. All right. Okay. Even when we're moving, they've decided we have to eat. So you don't get to include meals, but you do get 23 cents a mile. Okay. So travel. If I move from Buffalo to Denver, I get my miles driving here. Now, my puppy doesn't like to ride in trucks, so it wants to ride in the car with my wife. Do I get to take mileage for both vehicles? Why not? I had to drive a moving van, and my wife had to drive a car. Yes, no, maybe. What do we think? Yes. If using a car to travel with household members or personal effects to the new home, figure the expenses by deducting either actual expenses or the standard mileage rate. So, if I had to drive a moving van and I have to drive my own car with the stuff that didn't fit in the moving van, what do you think? Yeah. Okay. Now, if I take off from Buffalo and I decide I'm going to go see Aunt Karen in Memphis and then Aunt Tammy in Minneapolis and swing down and see my cousin Joe in Nebraska before I head to Denver, are those miles? No, that's where Google Maps comes in. Point A to point B, okay? We can't do a zigzag. I had somebody that as a client one time moved back from Arizona to Buffalo, and they showed me the miles, and I was like, that seems like an awful, how'd you come back? You know, I'm thinking, did you take a trip through Vancouver? And they had done that. They had stopped and made a few visits to see relatives on the way back that they usually don't see, and I said, can't do that. We're just gonna have to figure out a straight line. I'm sorry, so. And we had to drop a couple nights of lodging because they stayed places they, you know, has to be reasonable, okay? Has to be reasonable, all right? Now, here's one of the caveats though, and we think about anything else that we have on a return. You cannot deduct, what is it here? Enter the total amount of your employer paid for the expenses listed on lines 1 and 2 that is not included box 1 of your W-2, or the amount should be shown in box 12. Basically, what's that saying? Can't double dip. If our employer is giving us, even though it's going to be taxable income, okay, we can't take that. And most of the time, if you're relocated for a job by an employer, what do they typically do? They usually pay for your moving expenses, okay? You may be able to do some mileage stuff and maybe some lodging stuff that they won't reimburse you for because you're moved. But, you know, the big ones with the moving company and things like that, you know, or they may just give you a stipend and make it tax. But isn't that nice? They ask you to move and then they make it taxable. They give it to you as benefits. Okay, so that's the big one on there that you got to make sure again that it's not something that you're reimbursed for. Okay, all right. Okay, moving down our list, back to 1040, page 1. Deductible self-employment. Whoops, come back here. Deductible self-employment tax, okay? If we go in there and open it up, see where it says SE, okay? So, we have all these wonderful lines for calculation of self-employment tax, all right? And church, and we take it and multiply it by 92.35%, then we take that, multiply it by 6.2, and then down below here, we got 12.4, then another 2.9, and then take half of that, okay? Again, did everybody write that down? Brent and Karen are looking at each other strange. Did you get that? Okay? Basically what I'm saying on here is this is the calculation. We'll talk about this more when we see the flow when we do Schedule Cs. The big thing that I want you to take note of is down at the bottom. Okay? It says deduction for 1/2 of self-employment tax. So once the self-employment tax is calculated, we get a deduction for 1/2. Okay? All right? The one that this will come into when we do some self-employment is I'll talk to you about ministers too, because the self-employment tax comes in with them too. All right? Okay. All right. So, let's see. Line 28, self-employed SEP, simples, and qualified plans. All right. So if you go in there, there's a little self-employment plan worksheet. Okay. So it looks like this guy. And you can see up at the top, net profit is what we're working on. Not our gross sales for self-employment, net profits. Okay. Schedule C, Schedule CEZ, that's that sole proprietor, small business, whatever it may be. Schedule F would be somebody on a farm. And then the 1065K1, that's that partnership that comes over there, or that, corporate return. Okay. So we talk about that. All right. Now, basically what's happening on this one is, we'll kill two birds with one stone here, okay? We got a net profit. You can see here, there's the calculation for the self-employed health insurance deduction, all right? So basically, this is where we talk about the, as it says up at the top, we can't deduct anything. If I have a spouse in a month where I'm married to somebody and they're paying the health insurance, and part of it's for me as self-employed, I can't do it. This is truly where I'm paying insurance for myself being self-employed. Okay? All right? So we get to deduct again, just our portion that we pay. Okay? And that's where you pay in there the total amount paid for health insurance. It goes right in there. But again, it's only the premiums for the self-employed person. Okay? Down at the bottom, we got a couple little things. And this is basically when you're self-employed, you set up your own 401k. In fact, there's a new product out there I'm kind of reading to learn about. It's kind of interesting. There's actually something that you can get and put more than the limit for a traditional IRA that's called a solo 401k. So basically, you can create your own 401k for just yourself, and allows contributions in excess of what you traditionally do. So I'm reading more on it. I don't quite understand all of it yet. So, but you can see up here, for a SEP, percentage contributed for employees. If there are no employees, enter the percent written in the plan, maximum 25%. So if I'm self-employed and I'm going to do a SEP, I could put 25% of my profits in there. Okay? So if I make $80,000, how much can I put in my SEP? $20,000. A lot more than that $5,500 we can do in a traditional IRA, isn't it? Okay? So you can see how that is there. All right? Okay? All right? And then down for the simple, you can see that, some of these have to do with if I work for somebody and I'm a small business and I'm allowing my employees to participate, okay? But there's some things with the simples down here that if I give those to my employees, they can actually contribute more. All right? Okay? This would make a lot more sense if we had time to go through and do a partnership return, because you would see the benefits flowing, because if you're a W-2 employee, your employer is getting a huge benefit by contributing or matching to your 401k, right? Okay. All right. Okay. Next one down is self-employment. We did penalty on, like I said, on the early withdrawal savings. Just remember, that's from when we have it on our 1099 INT. It just carries over here. 31, alimony. Alimony paid. What do we have to put in there? Recipient Social Security number. Gee, I wonder why. Okay? All right. So basically what that's saying is the IRS wants to know who you give it to because they want to make sure they pay tax on it. Okay? All right. All right. Let's take about 5 minutes. And, okay. So we're going to continue on, write down our adjustments to income. We just talked about alimony. This is the big one that we typically see, the IRA deduction, line 32. Okay? If we go, there's an IRA worksheet. That's a link in our little square. At the top, it's in the traditional IRA contributions category. Okay? All right. So this is the one that we have. And there's a little thing that's kind of similar to what you have inside your textbook that talks about the maximum modified AGI for deductible contributions. All right. So it kind of depends on if you're participating in a retirement plan from your employer and things like that. Okay. Because I have people that say, oh yeah, we do that every year. We put in X number of dollars. And some of them I've had to say, well, did you know it's costing you money to do it? It's not helping your tax bill because sometimes you end up having an excess contribution and you pay a penalty. All right. Or the money's going in there and it's not reducing the tax bill. All right. So you always have to make sure that you take a look at the worksheet up above and see, you know, what the calculations are. All right. As we move down on this, the first thing you can see there is that are they covered by a retirement plan? Okay. Down here, it has our little spot for our contributions. All right. So, you know, it will take and it will show you a number that says maximum contribution based on earnings. So if I have somebody that has very high income, you know, I'll take a look at this one because we might be putting $6,500 here for each of them, but this number based on their income might only read 10. So anything over 10,000 for them, there's no bang for the buck. And if it's not going to help them on their taxes, I may say to them, well, is there anywhere else that you could put that money to have it earn something? It's not really helping us on our taxes. It's great that you're putting it there. But if our intent is to lower your tax bill, we're not doing anything. Okay? So we can put that in there. And you can see in this case, $6,500, why? Because they're over 50 years old. All right, you get that extra $1,000 catch up. Okay. At the bottom of this one is the Roth contributions. Again, same kind of format with the maximum AGI, shows the allowable contributions. But if I put money into a Roth, does it help me out on my tax return? No. Why?
Because it's
Yeah,
not
it's tax-free when you get it out.
Yeah. Yeah, this is money that we're basically have already paid tax on going in there. And then we're looking for the benefit on the other end when it's tax-free coming out. Okay. All right. But much the same thing. You know, if we have somebody that, you know, in this instance, if I take Harry Healthcare here, and his W-2, he's making $25,000. And he's putting $5,000 into his retirement. Okay. And I go to the IRA worksheet. Okay. So I put $5,000 in there. It helps us out a little bit. Okay. But because of the income and his participation in something, you know, putting money in for, you know, for the spouse doesn't do us anything. Okay, so you can kind of fiddle around with it. This is a perfect spot for the what if. Everybody know what the what if mode is? Remember that? Yep. This is a perfect spot when you get done with somebody's tax return is to turn the outside of it the color of baby food, vegetables. So, because it is that. Has everybody ever noticed that every baby food vegetable is that same color of green? Just labeled different. Doesn't really taste different. So, My grandson was over yesterday, and he's well past baby food, but I can just remember looking at him and was feeding some of those bottles to him going, you know, don't worry, it's not all like this. Life gets better. Not all your vegetables are going to be the same color and same consistency. You get some teeth and you'll be all set, okay? So that one we have there, okay? Now, next one down, we did the IRA, student loan interest. This one is absolutely scary, okay? And it's a shame the way it works, but that's just, student loans right now are out of control, okay? I mean, out of control. I don't know how many people I talk to that have $150,000 and more in student loans, you know, because they've gone through, you know, medical school or getting their master's for education or whatever it is. And you can deduct interest up to $2,500 per person, taxpayer spouse, okay? All right. Now, what happens if I have a parent that has a parent loan and they're paying on it?
The parents paying the.
It's a loan in the parent's name and they're making the payments. Yes? No? Maybe?
Are you saying if they're paying just that loan, or do they also have their own student loan?
Well, no. They're paying, there's a parent loan, you know, the loans that you can get as parents for your students. But they're not on your return, but you're still paying on the student loan. Can you deduct the interest? Yeah. Why not? You're paying it. It's in your name. Okay? All right? But up to $2,500. Now, bad deal, what do we read down here in the bottom? Our light bulb starts to get dim at $65,000 for an individual. And the light bulb goes out at $80,000. All right? Best example I have of this is a married filing joint, it's $160,000. I have a client, she's a pharmacist for Walgreens. Gets paid very well. But pharmacy, that's 8 to 10 years in college. Right now, her student loan payments are greater than she and her husband's and their daughter's mortgage. But because she makes good money and her husband works, she's got all these student loans and doesn't get any credit for it on the interest. It's a shame.
Wouldn't she get credit for at least $2,500, even though she paid in more?
Their income is greater than $160,000. All right, because that's with some people where, you know, you went and got this, you know, your MBA and you got this great job. You're thinking, oh, I can write off these student loans. Oh, okay. Now, the one thing I will tell people when I hear them talk about student loans, I say make sure if you're in default or, you know, it's being deferred or whatever, keep the dialogue open with the student loan places. Don't just ignore them. And especially if you're in a situation where you're not talking to them because you're out of work, that's the time to talk to them. Because they will do an income-based adjustment. And worst case, what happens if they forgive you $10,000?
Cancellation of debt.
Cancellation of debt, but I'm only making $9,000. That $10,000 really ain't gonna hurt. Now, if I'm making $65,000, $10,000 is gonna hurt. Okay, but talk to them. Talk to them. You know, because even the case that if you can get your interest rate changed and maybe a little bit of forbearance that they'll backload it a little bit for you until you get back on your feet, that's a lot better. And someone will look at me and I said, you know, the only thing is, you might take some hits on your credit. And their next look at me is, doesn't matter right now. I have no credit because a lot of them have really, you know, squelched their credit by what's happened with their student loans. So it's a shame. They're coming out of college, 4-year degree, maybe a master's, can't find a job. Their credit's shot because their student loans are so high. You know, what are they supposed to do? And that was one of the things in the elections. Obviously, it was a hot topic. You know, is trying to figure out a way for students not to have all this. But, you know, it's hard to say. You know, it's hard to say the answers. Free tuition for everybody? I don't think that's the answer. Because it's basically the same thing. Because if you give it to all the kids going into college right now, when are they going to pay for it? later because their taxes have to go up to pay the bill off because of government. So it's kind of 6 of one, half dozen of the other there. Somebody's still going to have to pay for the tuition. It's just at a different time. So, but there's got to be something. Maybe it's just the tuitions itself. So my son that's in Cleveland, we were smart enough this year. In fact, I told him last year, he says, okay, you got your chance to experience living in the dorm. Time to go off campus. You know, go find some buddies and rent someplace. All right. And the fact that I got him out of the dorm, no room and board, just saved myself about $8,000 to $10,000 a year. I would hope what I'm paying for him to live in that dormitory that my name is on the outside of the building pretty soon. So, because they should be naming it after me because I've made several mortgage payments for that brand new dorm. Okay. All right. So we have that one. Okay. But again, it's a tough one because you're going to put it in there with somebody that has good income. You're going to go, well, how come they didn't get the student loan one? It phases out pretty quick. I mean, for an individual, $65,000. You know, if they have a 4-year degree or a master's, chances are they're probably in that area. And all of a sudden, you know, they're not getting credit. Okay. All right. Oh, before I forget too, the other thing with student loans, sometimes people, and it's not a bad idea, but if you do have the forgiveness or cancellation and you're married, and the person with all the student loans is not working at the time, there is a way that it is a perfect storm that you can do married filing separate. Okay, you have to be very careful. The student loan people will say, this is how you do it. And you do a married filing separate and only one takes the hit on the cancellation of debt. But you have to weigh that against what with married filing separate? Yeah, if there's a family and kids and stuff, you have to be careful because what you save by doing that with the student loans may not be enough to offset the cost to you on your refund. So you have to be careful.
Would they go still married filing joint and then do innocent spouse?
Injured spouse?
Yeah.
Injured spouse? You could. Anybody know what injured spouse is? So what happens when you have two people doing taxes together that shouldn't? Injured spouse, I don't know why they call it that. It's the first thing that always comes to mind. You know, you're thinking, it has to do with domestic violence? Injured spouse is where you create a partition in a married filing joint return. What I mean by that is if somebody is carrying tax debt that they can't pay back and they're taking the refunds, you create an injured spouse partition, and then that way that the injured spouse stays separate. And anything that is for them, they still get in the refund. You don't do that, and the person that has all the tax liability, and it's greater than the refund for the family, the refund's long. But if you do an injured spouse, it creates a partition. Okay? And you can do that, Michelle, after the cancellation of debt, and if the tax bill is not able to be paid. Okay? The married filing separate is to get the cancellation of the student loan to be a one-shot deal. But you know, if they cancel and forgive $40,000, it's a $40,000 paycheck on a tax return with no withholding. So the tax bill is going to be huge. And a lot of times they'll do that way, and then they can't pay the tax bill. Then you have to do injured spouse because they're turning around taking the refunds because they can't pay the tax bill and the forgiveness of the student loan. So you got to be very careful with that. Obviously, the student loan places are going to paint this great rosy picture and say, hey, we're going to forgive all your student loans. You just got to pay this. You know, and then all of a sudden now, you know, they're thinking, oh, great, student loan's done. But now they got the IRS on their back because they can't pay their tax bill, and they're taking the refunds. So, again, you got to really weigh it from start to finish. So, okay. All right.
Does the student loan have to do with the federal government, Department of Tax?
Does the student loan? No. No.
It's with the bank.
Yeah, you know, some of them, and there's several different places. Some of it's based on state. I know we looked into some student loans for my son who's in Ohio now, and you know, the school had a link and people that they dealt with, but there was a lot of them was banks in Ohio. So there are some national ones that do it. Was it Sally or Anime? Sally, which one was the student ones? Some of those ones on there. But yeah, just who you want running your student loans, the same people that caused the housing crash. So, all right.
Is
Okay.
there any adjustment or anything for 529?
On the state, there is, yes. Yes. Yep. Okay. All right. Okay. When we do New York considerations, we'll talk about all those with the 529. Okay. We got the let's see, student loan and tuition and fees. What this one is, it's at the bottom. Come back here. All right. We're going to go on the same form we were just on for student loans, and at the bottom, there's a tuition and fees deduction. Okay. However, even the form realizes that some things to consider, okay, before you fill out this form. What's the first thing they list? 8863, the American Opportunity. So obviously they know, and now you know, probably the first place you should go, okay, especially if you have an undergrad. The other thing too is, if you look at it, 80,000, no more tuition and fees deduction, okay? What's our lifetime learning one? 65 and 90 for the educational. So that's something you want to weigh too. It's kind of one of those perfect storms because you got to kind of take a look at a person's income. Well, if they don't get the lifetime learning because of the phase out, maybe I can go with the tuition and fees and see if they'll get it there. Okay? So if you see somebody that you do an American Opportunity, obviously the thresholds are much higher. And like I said, undergraduate, the refundable portion. But if you're using lifetime learning for somebody that's in grad school, if they have higher income, we might go to the tuition and fees. And we'll see this in the problem that we're going to do, okay? That will maybe that's where the better spot is, all right? And remember, you have to weigh not only the federal, but the state too, okay? The reason I say that, what do we use on New York State to calculate our tax? What's that number that we carry over? Federal AGI. Exactly. And what are we doing right now? We're trying to lower our AGI. So if we do use the tuition and fees, chances are we're going to lower what we take to New York to calculate tax. So that's where the benefit may be in. Okay? All right. Okay. All right. So here's what we're going to do. Open up your workbooks and go to page 117, Howard and Janet Hamilton. All right. And we're going to put those guys in there, okay? So if you want to start, what I want you to do is get their information in there and then get their W-2s in there, okay? And their interest. Well, no, don't do their interest. Just get all the biographical stuff done. Get their W-2s in there, and then we'll go through the rest, okay?